Mortgage qualification overview. First things first, lenders want to know you're financially stable. This means a steady income, so no job hopping right before applying. If you just switched companies, you'll likely need at least 3 months in a new job if it's similar to your old one, or 6 months if you've started a completely new role at a new company. Next, they'll look at your debt level. Most lenders want to see a credit score of 680 or above in order to qualify for a mortgage. Don't stress if your credit score isn't quite there yet. There are still options with B lenders, but you might have to pay a slightly higher interest rate if your score is below 680. Then they'll look at your income, i.e., the amount you're making, and whether you can support the monthly payments. When it comes to income, be ready to produce pay stubs. If you're self-employed, don't sweat it. There's plenty of options for you too, but typically you'll have to show your last 2 years of income to show an average of how much you make per year. Now let's talk about down payments. If you can put down at least 20%, you'll get access to better mortgage options, i.e., potential for longer amortization, home equity lines of credit, etc. If you don't quite have the 20% down payment, not to worry, you can get mortgage default insurance through CMHC or other insurance providers. It costs you a bit more overall for the home, but with as little as 5% down, you can get into the market. Now, for debt service ratios, your monthly housing costs shouldn't eat up more than 39% of your gross total before expenses income. And when you throw in all your other debts, keep it under 44%. We call these the gross debt service, GDS, and total debt service, TDS, ratios. Have a peek at your budget and figure out your current debt versus income percentages. Next, mortgage pre-approval. Get pre-approved before making any offers so that you know what you can afford. Lenders will look at your finances, i.e., income, assets, debts, your credit history, which we talked about earlier, and proof that you've got enough for the down payment and closing costs in your bank account. Last but not least, let's chat about Canada's stress test. Basically, you need to prove you can handle higher interest rates, even if you're getting a sweet deal from your lender. Right now, that means qualifying at either 5.25% or your rate plus 2%, whichever's higher. This can fluctuate, so check with your mortgage broker before making assumptions. Now that we've covered all the requirements, let's review. Here's your recipe for mortgage success. Start prepping early. Your future self will thank you. Pay off as much debt as possible, especially credit cards. Team up with a mortgage professional to ensure you're doing things the correct way the first time. And lastly, stay put in your job. No job hopping right before mortgage applications. Remember, there's no one-size-fits-all with mortgages. That's why having a mortgage professional in your corner can make all the difference. Please reach out if you need recommendations for mortgage brokers in your area. Now, are you ready to turn that homeownership dream into a reality? With a little prep and the right guidance, you'll be on your way to picking out paint colors before you know it. Please reach out if you have questions. I know mortgage info can be a bit to wrap your head around.